Joining me now in an exclusive interview is IMF Chief Economist Pierre-Olivier Gourinchas. Pierre, it's great to see you here at Jackson Hole. Thanks so much for joining me.
Thank you for having me, Jennifer.
There have been concerns that the U.S. economy is slowing following the July jobs report. Since then, we've gotten some more reassuring data in the form of jobless claims, retail sales. Nevertheless, there are some who feel the Federal Reserve is a bit behind the curve. What's your sense? Are they behind the curve? Have the chances for a hard landing in the U.S. increased?
Well, I think we should step back and look at where we are and where we were maybe, let's say, a year and a half ago. I think the really key thing here is the U.S. economy has been doing really very, very well. I mean, we've had activity exceeding expectations. We've had inflation coming down. This has been slowing down a little bit, especially in the first part of the year, but now it seems to be coming down again. And so overall, the U.S. economy is in a very good place. And so I think it's certainly true that we've seen the labor market cooling off. We've seen unemployment rates increasing. We've seen quits and hiring coming down a little bit, but coming from a position of strength. And so from this perspective, I think the Fed's approach is entirely appropriate, which is they're saying now that, there's less inflation risks. Chairman Powell mentioned that, labor market considerations are not a key driver of inflation dynamics going forward. And therefore, they'll start thinking about sustaining activity and seeing inflation coming back down further.
You heard Fed Chair Powell this morning. Given what you just said, what do you think the path for monetary policy looks like this fall, right? It's not just about, hey, they go 25 basis points in September. It's really the big pivot here, the next cycle, right?
Well, we've seen a number of central banks in advanced economies already starting to cut rates. The European Central Bank, the Bank of England last week, Bank of Canada and others. And we're seeing this path of inflation coming back closer to target. In the U.S. right now at the IMF, we're projecting that PC core inflation will be around 2.5%. By the end of the year, we'll be back to target next year. So it's natural that there would be a move by the Federal Reserve to move back to neutral. Now, whether that will happen, of course, we expect that some of it will happen in a few weeks in September, but the pace of it will be dictated by whether there are surprises to inflation on the upside or on the downside and to activity.
So you don't have a forecast for, hey, you see 3 rate cuts before the end of this year sort of thing?
Well, as of our earlier reports, we're expecting maybe 1 rate cut before the end of the year. I think given the news we've had since then, since our July update, labor market cooling off a little bit more, inflation numbers coming in and easing further, I think we can expect a little bit more than that.
Like you said, the ECB, the Bank of England, they've already started cutting rates. The U.S. a bit late to the party here. We did see an unraveling of the yen carry trade. Once the U.S. does cut, what do you think lurks out there? What sort of domino effects could we see? What are the risks to global financial markets, if any?
Well, I think there are 2 possibilities out there. One is that as the Fed is starting to cut policy rates, what we'll see is a difference in interest rates between the U.S. and other countries is going to shrink, and that would support the currencies, especially in emerging market economies, that would allow them to maybe cut interest rates further themselves because they will face less depreciation on their currency, and that's kind of a good scenario. Now, if we have a scenario where there is a cooling off of economic activity that's much sharper and the Fed needs to ease much more aggressively, then there could be a lot of volatility, and then that would be working against emerging market economies. So I really think it's the pace of cooling off of aggregate activity that will be dictating, how global markets are going to respond.
What about inflation, though? We're hearing some thunder here in Jackson Hole, so hopefully this rain will stave off. But you said in your global economic outlook just in July that inflation is expected to come down slowly because you expect services inflation to be sticky, and so that rates could remain higher for longer. Are you still sticking with that outlook now, given what we're seeing around the world as well as in the U.S.?
When you look around the world, you see that for some countries, inflation pressures remain quite significant. You look at a country like Brazil, for instance. And so I think we need to differentiate a lot across different jurisdictions. And it's certainly the case that if you look at the overall inflation numbers, they are heading in the right direction. But we do see some stickiness of inflation in services. Now, how much of that will continue, I think will depend in part on how much labor markets and activity are cooling. So right now, the projection is that this will come down and inflation in services will moderate, but that's an upside risk to inflation.
And what about your overall outlook for global growth right now? Has that changed at all? I think you were projecting 3.2% back in July for this year and 3.3% for 2025.
Well, we are currently doing the assessment for our next round of the World Economic Outlook, which will come out in October. So right now, our projection is still the July update, which you just cited, 3.2% for this year and 3.3% for next year. What we have seen since our July update is certainly some cooling off, some moderation of activity in some jurisdictions, including the U.S. But whether that will change our global outlook, we don't know yet.
I want to ask you, how do you see officials weighing the risk of rising price pressures against the danger of economies tipping into a downturn? I mean, does that raise the risk of more volatility?
Well, the mandate of many central banks is really to first make sure that there is price stability. And price stability in the sense, if you really have a lot of inflation, that is really not conducive to growth and economic activity. So bringing down inflation is a priority, I would say. Now, as inflation comes down and you come closer to central bank targets, at that point, a pivot like the one we're seeing right now with the Federal Reserve and we've seen with other central banks to take into consideration the broader picture when labor market pressures are not contributing to inflation pressures any longer or not significantly, then I think at that point you start wondering about maybe let's make sure that we have indeed a soft landing, that we don't have an overshooting on the labor market and aggregate activity.
When you look across the global economy now, what worries you most?
Well, I think we have to be concerned that the sort of pivot that we're seeing right now, where we have many advanced economy central banks are starting to ease, in an environment that is still quite uncertain, we could get some upside surprises on inflation. Some central banks may have to hold interest rates higher for longer. That could create reassessments in financial markets. That could create volatility. We've seen an episode of financial volatility a few weeks ago related to expectations of maybe faster cooling of the U.S. economy at the same time as increases in interest rate in other places like Japan. We might very well see other episodes like that, and I think policymakers should be ready for that.
So is there a risk something could break in the global financial system as we go through the fall?
It's always very hard to predict, but I think the important message is let's be ready, let's have the right buffers, let's have the right policy instruments to deal with volatility when it arises.
Switching gears a bit, in your World Economic Outlook back in July, you warned that trade tariffs could generate damaging cross-border spillovers, as well as trigger retaliation, resulting in a costly race to the bottom. We know that former President Trump has proposed tariffs on all U.S. imports of 10% and tariffs of 60% specifically on Chinese imports. How do you see that, if that policy were to go into effect, impacting global trade flows as well as the global economy?
Well, so first, look, I should be very clear. We're not going to be commenting on, economic platforms of different candidates in the context of a national election. But I think what we can say is we're always a little bit concerned about implementation of trade restricting measures, whether that's tariff or other types of measures that would come and do harm to the global economy, potentially could lead to retaliation from trading partners and an escalation of trade tensions. We've seen a lot of new trade restricting measures that have been implemented in the last few years. We are concerned that it might at some point weigh on growth, weigh on global trade, and slow down the kind of growth that we need to be able to address some of the challenges we're facing. So certainly we would recommend that a lot of moderation be expressed in that area.